and welcome back to the accounting videos dealing with stockholders' equity section. Now that we've gone through the process of seeing how the journal entries play out when you issue stocks and you pay out dividends, we're now going to focus on the presentation in the balance sheet. We know the accounting equation is assets equals liabilities plus owner's equity. Now we're going to look at a little in-depth into that owner's equity section, just a presentation. So let's look at an exercise and see what that's going to look like. So in this exercise, we have an example of Wells Fargo, which is headquarters in San Francisco. It's one of the largest financial institutions. They tell us, suppose these are their numbers at December 31st, 2022. They want us to prepare the stockholders' equity section of the balance sheet at December 31st, 2022. So we are focusing on the balance sheet, but obviously just a partial balance sheet. All I'm concerned with is the stockholders' equity section. So let's look at all the account names that are given here, analyze these account names and see what they are. Once again, we are looking at a very elementary presentation, an example. We have retained earnings, preferred stock, common stock with all the details, treasury stock, paid-in capital in excess of par for common stock, and then we have accumulated other comprehensive income. So as you know, in the income statement, you have revenues minus expenses, the net income. That net income flows into retained earnings, and retained earnings is a part of the owner's equity. So for the stockholders, you're basically looking at the claim of the stockholders against the assets after the liabilities have been paid off. Assets minus liabilities is stockholders' equity. Now, some of that, the stockholders themselves put money in. So we will look at the paid-in capital. What did they pay in? Okay, so there are two parts, the capital stock, and the second part is additional paid-in capital. So as you saw in the previous exercises, when a company sells their shares, it is almost never going to sell at par or below par. It always sells above par. So whatever the par value is, the capital stock, anything above par is the additional paid-in capital. If you have different classes of shares like common shares, preferred shares, you want to keep a separate account for each of those paid-in capitals. When you get to your intermediate class and the advanced class, you will see the details of why we need to have those as separate accounts. When the company buys back their own shares, it's called treasury shares. And that's a deduction of the stock from the stockholders' equity section because it's no longer outstanding. So let's first start out with capital stock. In capital stock, you will list your preferred stock first, and then you list your common shares. So I have the preferred stock. They've not given me any detail other than saying it's 8485, and this is in millions of dollars. And I put that number in the inside column, the 8485. The common shares, I have 6 billion shares out authorized, of which 5.2 billion have been issued. And I put that number over here. I'm concerned with the 8743. So my total capital stock is a combination of these two numbers when you add them up, the sum of those two numbers. So again, capital stock is basically just the par value of the common shares and preferred shares. Now, preferred shares, they've not told me anything about whether it was, if it was issued in excess, the assumption is no, it issued exactly at the par or stated value, whatever that may have been. However, my common stock did issue in excess of par and quite a bit in excess. So that's what's going to be listed next. Okay, so the additional paid-in capital, I have only common shares. I'm going to list that number over here. If I had more, as in even the preferred stock information, I would have listed it here in the inside column. Now, although it's just one number, I put that in the inside column just for the sake of presentation. And I say my total paid-in capital in excess of par is the 52,878. Now, this is a total amount of money that the stockholders have given me, the corporation Wells Fargo. This is the total investment that they have made. So that's the total paid-in capital. They paid in the stock, the par value, and in excess. That's the actual money that that Wells Fargo has collected when they issued shares. The next thing you're going to list is retained earnings. Again, what is retained earnings? As the word suggests, earnings of the firm that have been retained. They've not yet been distributed. Retained earnings over here is given as 41 563, and that's the number I write here. Now, if there are any restrictions on these retained earnings that the company has put on themselves in terms of, say, they say they want to keep some money aside for plant expansion, etc., that will have to be listed over here. In this case, they've just told me retained earnings and they've given me the number. Okay, so this number over here is simply called total paid-in capital and retained earnings. All of this belongs to the stockholders. Okay, you can't go and tell the company, I'm the stockholder, I want this money. This is yours in the event of liquidation, and that's not what we're going for. Okay, next we're going to list other comprehensive income, accumulated other comprehensive income. This is beyond the scope of what we do in our principles of accounting class, but when you get to your intermediate accounting class and advanced accounting class, you will focus on this. So once again, revenues minus expenses is net income. Net income becomes a part of retained earnings. There are some items that we do not, the accounting term we use is it bypasses the income statement. We don't put it in the income statement, but it affects your owner's equity. So we bring it directly over here. And that's what this is, accumulated other comprehensive income. And that amount in this exercise is 8327. Now, finally, if there's any treasury stock, I will list it over here. Treasury stock is basically the common stock, in this case, that the company has bought back. So of the shares that were issued, the company bought back 67 million shares. Okay, of the shares that were issued, they have bought back 67 million shares. They're no longer out there with the public, and that has to be subtracted. That will finally give you the total stockholders' equity. So once again, I'm going to highlight this portion over here. We have paid-in capital, and you have additional paid-in capital. This is the monies that are when the company issues shares in the stock market. The first time they sell it, any money that the company gets, that's paid-in capital and additional paid-in capital. That combined is called the total paid-in capital. You add to that the retained earnings, that gives you total paid-in capital and retained earnings. That's really the number you're going for. You're looking for this number, the retained earnings. That's telling me the health of a company. And then accumulated other comprehensive income. Again, as I said, in the principles of financial accounting class, it's really beyond the scope of what we need to know for now, other than these are items that bypass the income statement, but do affect the equity section. Treasury stock, we do need to know. This is stock that the company has bought back. And what could a company do with treasury stock? As I said in the previous exercise, a company can choose to reissue those shares. They could give it to their employees, or they could choose to retire it and it'll no longer be issued. So they have a variety of choices what they can do, and companies typically have a strategy in why they bought the shares back and what they plan to do with it. So the presentation is very important. All this information together is the stockholders' equity, but the order in which you present is important because it's telling me something about the company's financial health. So for the principles class, this is the last lecture I have for the stockholders' equity section.